to have a moment of silence because we don't have the Colbert Report anymore. I don't know, was I the only one who watched Colbert? Jon Stewart's gone, Colbert's gone. There's not really a trusted news source anymore. Bill? Yeah, okay. All right. Trump versus Sanders. The important thing to realize for what we do, neither one of them is either a sign of fantastic success or dismal failure. Neither one of them is going to really hurt us or help us economically or our investments much. If you ask a pundit from CNBC, you'll get one information. You ask a pundit from NPR, you get a different piece of information. They all have an axe to grind. Everyone's talking their book when it comes to politics. You know, the full cycle, the full up and down crosses many presidents every time. There's not any president that, hey, this president's action was the president that did it, because it was always a different Congress that started it and the president, you know, I'm not worried about it. Here we see this, it looks like the third year in a presidency is the best year, and that's probably true. But every year on average is a positive year. So this is what I was just talking about a second ago. When you look at the start of the recession, expansion, end of the expansion, it goes across and it happens in all kinds of different categories. You can't step in the same river twice. It's not the president that does it. The president is a single factor among many, many, many factors. There are social issues that are important. Economic issues, not really the president's place. I'd love it if it was, but it's just not. Okay, so we talked about this earlier. Looking at getting out of the US for a second and going more global, there's two countries that are sucking wind, right? Russia, Brazil. But the thing I want you to look at here is this was going into 2015, the expectation and the actual GDP of all these countries. And where the expectation was negative, it was more negative than expected. Okay? But in every other instance, it's pretty close. We do a pretty good job of guesstimating GDP. We do a horrible job of guesstimating what happens in markets. But we do a pretty good job of guesstimating GDP. So if you have a GDP that's increasing, too far. If you have a GDP that's increasing, what is that going to mean for companies in that country? If GDP is going up, what's happening? We're producing more. Okay, if we, yeah, business is doing good. So if GDP goes up a little bit, right? Some companies are going to do much better because they're going to learn how to navigate the little bit of growth waters. Some companies are going to fall apart. Some companies are going to do average. On average, companies are going to do better. There's going to be an opportunity set that's improving. Whereas right now in Brazil and Russia, the opportunity set is declining. So companies are going to have a harder go. Okay? There's going to be a point when those are going to be attractive buys. Okay? I don't know when that point is. We just have emerging markets. I'm not trying to pick Brazil versus Russia. It's just having something that goes down doesn't make it bad. It makes the opportunity grow. Having something that goes up doesn't make it great. And this is all pretty stable growth. But look at this. So they just reported, I don't know if it was Q4, 6.9%. Right? And everyone says that's a bogus number. Let's say it's 3%. Okay, it's a $10 trillion economy. What is 3% growth? What's the increase in the opportunity set? Is it less than expectation? Yes, it's less than expectation. Has the market already factored that in? I mean, China's done horribly for 5 years relative to everyone else. So it's kind of already baked in. That's why that's an opportunity. The growth is continuing. The market's not reflecting it. And yeah.
So when they refer to the BRICS, that's
Brazil, Russia, India, China.
India and China. Okay.
Yeah.
So 2 of the 4. Okay.
Yeah. Yeah. So this is the reason, right? Oil this year fell from 106 to 40 by the end of the year. Now it's sub 30. So we'll talk about. Actually, we're gonna have some fun with oil right now. Okay. So does anyone remember when oil was underneath, or not oil, gas was under $1? You do remember?
Yeah.
Okay. What year was it?
1970.
Okay. So Jimi Hendrix plays at Woodstock. What year?
69.
New York Mets win the World Series.
I think 90 something. It was like 90, 92, 93.
It was 69. It was $1. Gas was $1. We're talking.
It's 93 cents a gallon. That's what he's saying.
Yeah. Yeah, 93 cents a gallon. Yeah. So 1969, and oil was $3 a barrel. Okay. Who remembers the year it crested $1 and never came back? It went through $1 and never came back.
Probably 72 for the oil embargo.
So when I looked at this, 1981 was the year I expected to get, because it went above $1 and stayed there for 6 years, but then it dropped back. Okay, so Milli Vanilli wins a Grammy for Best New Artist. Later taken away, but they win it. Okay. Okay. Buster Douglas defeats Mike Tyson. What's the year? 1990. 1990. Cost of a 30-second Super Bowl commercial, $700,000. So recently we had a year that was incredibly volatile with oil. Christina Aguilera wins a Grammy for Candyland. Anyone have an idea? What's the year? Yeah, everyone's like, Christina, what? Phelps wins 8 gold medals. Swimming fans? 8. 30-second commercial, 2.7. So June, it was $144. Last of the year, went to $36 a barrel. Okay, do you remember what was happening in that year?
Phelps won 8 gold medals.
aside from Phelps winning 8 gold. Market crash.
Yeah, big time.
Followed by what? Massive recession. All bad things. Lots of bad stuff happened that year. Okay? So that's a period.
Weston was a penny stock.
Yeah, no longer. So that's this right here. So this is world liquid fuels consumption, the red bar. Okay? So this is the red bar cratering, huge. Okay, why is the price of oil declining today?
Well, I've heard that there's better supply.
Supply.
Yeah.
What?
Production. It's production, not consumption. So our issue today is not a consumptive issue. So it's not that we're going towards recession because of this. We drilled too much, we produced too much, now we have a glut. Now we talk about the commodity cycle. So let's pretend there's 10 people. There's 10 oranges. Everyone loves oranges. We price the oranges at $1. Everyone gets an orange, it costs $1. Now let's say there's 100 people, still 10 oranges, right? Everyone wants an orange. What happens to the price? Goes up. Okay? And now that the price of oranges is up, what happens to the oranges? More people produce oranges. People plant trees, just like people drill wells. And so now we produce more oranges. So the next year, there's still 100 people and there's 300 oranges. So what happens to the price of oranges? Goes down. This is the commodity cycle, pure and simple. So what has happened in the last 6 months now that oil is really, really cheap? What car is being sold more here? Big cars.
The SUVs.
SUVs, trucks.
I've also heard it's incentivizing people not to buy further away from the city center.
Right.
because
It's
gas is
cheaper.
cheap. Yeah.
You look at the analysis of where I'm going to buy my house. Oh, transportation is cheap because gas is cheap. Is that going to be a long-term effect? No. No. Gas prices are going to go up. But people never learn. I don't know who said that, but that's exactly right. We don't learn. Commodity cycle is written. Just like stock prices follow earnings, commodity cycle is a written thing. It happens all the time. We're always surprised by it. Shouldn't be surprised. So this is projection into 2016. There's no decline in consumption expected. Okay? So if you look back 25 years, the average increase is about 1.4% per year in consumption. If you look back just 4 years, the average increase is 1.4% per year. So over time, it seems pretty regular that we can just assume that we're going to keep using more oil. And okay, maybe solar's on every house and the increase in oil usage goes down because now we can charge our semis and do, right, and maybe aircraft, because we do have test aircraft that are solar aircraft. They can't carry a lot of people, can't carry a lot of packages yet, but maybe we get there. I mean, maybe that's possible. Maybe the Tesla patents are used in aircraft someday. We'll see. But there'll be another use for oil, because remember, we don't just use oil for energy. We use it for Tupperware and clothes and plastics and PVC pipe, and we use oil in lots and lots and lots of different ways. So it's unlikely that this particular commodity cycle goes away. Okay, here's another issue. It's not so much that the Fed is raising rates. It's that we have one Fed raising rates, a couple other Feds that are still on QE. So Japan, Europe, still QE. So what does that do? In the short term, it's going to spin everything into some weirdness. There's going to be a lot of longer term. We have no idea, but we're going to have a stronger dollar, which maybe we already have. Maybe in August when they said, "Hey, we're definitely going to do it this year," and then October they said, "No, seriously, we're doing it this year," and then December they did it. Maybe we've built in, because the dollar is up 15 to 20% depending on the day. The dollar is so strong, making our exports very, very difficult. So maybe it's already baked in, that increase in the dollar, which makes it tough for us, but maybe we have some room for a little bit of fallback in that this year. It's not going to hurt us the same way this year as it did last year, because the dollar can't go up another 20%. Now, right, can't. Never say can't. It's possible, seems very unlikely. Okay. This is the slide I want to talk about a little bit right now. So price-insensitive buyers have been the explanation in a whole series of market price movements that otherwise have not seemed to make sense in a historical context. I'm going to stop there. So what's a price-insensitive buyer?
Somebody who buys high.
Someone who buys regardless. So who is that?
Institutional buyers.
Companies buying their own stock back, often stupid, timing-wise, but often just consistent. They just constantly buy their own stock, which is great.
Right.
Great for the shareholders. Pension plans, money just keeps getting pumped into them, they got to buy. Insurance companies, they got to buy. They have to, they don't have a choice. Ready for this one? This is the one that's most interesting to me. ETFs. If you put money in an S&P 500 ETF, it has to go and buy all the stuff in the ETF at whatever price it is.
What's an ETF?
Exchange Traded Fund. It is the fastest growing investment tool ever. And there's like 3,000 of them now. They cover every index, they cover manufactured indices. So I looked at the top 10. I just said, okay, what are the top 10 in terms of asset value? The top 10 in terms of asset value, you could say 5 to 6 of them are basically S&P 500 funds. So why did the S&P do so well? One of the reasons is because people keep pumping money into SPDRs, there's a $165 billion ETF that's SPDRs, which is the SPY, which is the oldest, one of the oldest. SPY and QQQ were sort of created at the same time. Everyone puts their money in there. It's the easy way to get the U.S. Investments, U.S. economy, S&P 500. So do you think, and the studies have been done, do you think that there gets some overvaluation to these companies? Absolutely. And it's cap weighted, so there's overvaluation in 10 companies. And guess which 10 companies drive the market? Those 10 companies. So it's something to be wary of, because they don't care. So I'm going to read the last half, because I got the first half, got to read the last half. It's worth recognizing that investors prepared to buy assets without regard to the price of those assets may also find themselves in a position to sell those assets without regard to the price of those assets. So one of the things that made 2008 so difficult was people tied all their money up into illiquid things, right? So if they sold this thing, they'd have to take a massive loss. So if everyone tries to go for the exits at once in the S&P 500, which I'm not anticipating, this is not prediction, I'm just saying that the structure of the markets is shifting in that the more people start investing in the S&P 500 specifically, the more opportunity there will be to hire a manager to trade against the S&P 500. Okay? Now, I'm not going to be the guy that trades against the S&P 500. I'm not good enough. But there are people out there that that's what they do. And right now, you're getting a ton of information from Betterment, Wealthfront, Vanguard, the Schwab people, that they're saying, hey, just, it's all the same, it's all efficient, managers are terrible, just use the ETFs. And that's just moving the needle towards more ETF usage. So eventually, that needle breaks. And it's going to break in a downfall. And actually, when you go back in history, managers outperform indices when things fall apart. They don't when things are going up. The last 5, 6 years, managers are awful. They don't pay for their own fees. It's terrible. But that's not when they're supposed to outperform. They're supposed to outperform when things fall apart. And that's what we're going to see. Not next year necessarily. Again, not predictive. I don't know when it's going to happen. But it's an interesting structural change. Okay. So, are U.S. stock valuations high? Some say no. Given the rate of interest, right now, this gentleman here, Stephen Alf, says we can expect forward PE ratios on equities to move to the low to mid 20s. Could be. That's usually the sign of the top. 20, you're going to see us peel a lot off between here and 20 on the PE.
Where are they now?
Now they're 15 and 16. Long-term average is 16-ish. This is S&P. We're not looking at the global S&P. Okay. Some say yes. So did anyone know who this guy is? Henry Blodgett? He spent some time in jail after 2000. He was one of the ringleaders for the selling and pumping of IPO stocks through Morgan Stanley. But he started Business Insider because they said, you're no longer allowed to act in markets. So he said, okay, I'll comment on markets. Anyway, so he thinks things are overvalued. And he's been saying this, had this same phrase over and over and over for 6 years. And this is what he says to look at. He says, look at the Schiller Cape PE 10. Right? This is an average PE ratio over 10 years of earnings. So current price, 10 years of average earnings. And you can see it's high. But look at this. The highest point of the fixed income, or of the interest rates, long-term rates, correlates with the lowest point, or one of the lowest points, of PE ratios. The Cape PE ratio. So this gentleman here, Henry Blodgett, is trying to focus us on one item without looking at its other pieces in the market. He's saying prices are too high. And yes, they're very high, but rates are way, 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 way down here. So what is that? So why does that matter? Well, when you're here and you can get a CD for 14%, you're going to do that. Why would I risk my capital for an 8%, 9% average return when I get 14% guaranteed by the FDIC? Why? That makes no sense. Here, I get nothing. I get 0 point nothing for 3 years. I think you get a 1.5% CD for a 2-year lockup. It's probably one higher than that. Someone's going to fact check it and talk to me about it. He's on his phone. He didn't. You heard me. Okay, good. She couldn't. Yeah. She couldn't get 1.5. I know there's a 2 out there. Yeah. I've seen a 2. Still, if rates are going up and you lock it up for 4 years, you're going to lose by locking it up for that period of time. Okay. So some say it doesn't matter. Some say all this conversation about high PE in the short term is meaningless. And I kind of agree with that. What we're looking at is the long-term return potential from a high PE ratio versus a low PE ratio today. So if we think that the US is a higher price and emerging markets are a lower price, can we buy some emerging markets and sit on it and keep buying it till 7 or 8 years until that comes to fruition? Absolutely we can. Because if we buy the S&P at a 20, if you buy the US at a high cost per unit of earnings, we have to wait to get the benefit out of that. Maybe it has to go down a lot before it comes back up. Maybe there's no increase in earnings for 8 years. It will return to its average 15. So if you're going to buy at 20, you're either going to see a decline in price or a slow increase of earnings to make it worth it. If you're going to buy at 10, you're either going to see a slow increase in earnings, that's what you're going to see, right? And so the price goes up. So there's this long-term history, and we overcorrect on the upside and we overcorrect on the downside along a 6 or 7% kind of a growth bit.